Welcome back to eGet Mac. We're going to continue our last video about the money and banking chapter. Hopefully, you had time to pause from at the end of the last video to stop and try the exercise suggested at the end, and you were able to get to the conclusion and the correct answers. If not, no worries. Just let me know and we can address those, whatever happened while you're trying to solve, and we can catch what's going on and be able to address that on our virtual class, or just let me know through an email and I can send you a solution as well. Okay, so how do we do this? We know here, hopefully I read the question right, and you know we have two points here. The first one, we need to calculate the money multiplier, right? We know the money multiplier is going to be equal to 1 divided by 0.10. Why 0.10? Because this is the reserve ratio, right? The reserve ratio in this case right here comes from right there, right? But we're putting in terms of decimal points, okay? So in this case, the money multiplier is going to be simply equal to 10, 1 divided by 1.10, okay? Make sure you can still see that division signal right there, okay? Now, what else can we do, right? The second part of this problem is extremely important. Even though I know you can get to the answer right away, I really want you to focus on the second part. Given that a recession is coming, is announced, that is upcoming by the central bank, right? What should we expect to happen with the money multiplier? Are banks going to react? And the way they react, is it going to change the amount of money in the economy, right? And that's the idea here. Well, if banks know that a recession is coming, they also want to make sure they're in good standards, right? And they want to avoid, and they know that during a recession, a lot of people are unemployed, and they try to use their funds. So withdrawals maybe tend to be higher as well, right? So to avoid those risks, the bank is going to increase its protective cushion, right? By holding more reserves than it's actually required to. Remember, the reserve requirement is a minimum lower bound of how much they have to keep, but they can always keep more than that if they feel threatened, right? In this case, maybe not all banks would do it, but certainly the more risk-averse banks would do so, right? And if that's the case, we know that the money multiplier is actually going to be higher than 10%, right? And let's say, just so we can see how this works out, let's say it increased to 20%, just so you can see the impact on this measurement, right? So if the money multiplier was, oh, sorry, I meant to say, if the reserve ratio is 10%, but banks hold 20%, then actually now, even though the expected money multiplier through the reserve required ratio says that it's 10, which is a upper bound, the maximum that would be, like I mentioned before in the previous video, right? Now, we actually know that if it was higher, if banks held a higher amount of reserves, that would reduce the money multiplier, okay? And you can see that here. So by increasing the reserve required ratio by holding more money than banks are required, they would be lowering the money multiplier, okay? So the money multiplier lowers when banks hold excess reserves, okay? So that's the goal of this exercise. And please let me know if you have any questions. So moving forward, what are certain things that can impact the money multiplier that I said we would talk about in the previous video? Well, like I said, the maximum size of the money multiplier is what we found based on the money multiplier formula based on the reserve required ratio, right? But if some of these assumptions are relaxed, that they're gonna hold, like I said, just the exact amount of reserve required, then this can be problematic, right? The central bank is expecting a certain amount of supply of money in the economy, right? Which depend on how banks are behaving. But banks can choose to hold more excess reserves. Why? Due to macroeconomic conditions, like I said, a recession that can alter the view of the bank about how much more of a protective cushion it needs during that time period. Or there's Federal Reserve regulations that could change as well, that could incentivize them to hold excess reserves. For example, like I mentioned, in 2011, the central bank decided to pay excess reserves, pay interest on excess reserves, right? That's an incentive for banks to increase that protective cushion, like I mentioned, which then slows down a little bit of the economic activity, of course, because the money multiplier is lower, so less money in the economy. But it does, the trade-off is that banks are now have a lower risk of insolvency, right? They're healthier in terms of being able to withstand negative shocks in the economy. Okay. It also depends on the alternative investments for the bank, right? Where can bank get a higher investment than earning interest on excess reserves, right? Or what is the risk of the investment given the current interest rate? Is it worth really keeping just the minimum amount of reserves required, or are returns so low on other investments that I should probably go ahead and keep a higher reserves with the bank, since I would get paid interest on excess reserve by the central bank, right? So all those characteristics, all those components can play a role into how can we define what the money multiplier is for the economy today. Okay, but keep that in mind. Higher recessions tend to lead to higher holding of reserves of banks above the minimum requirement. Okay. Also keep in mind that, as the video mentioned, that the margin revolution video mentioned, it also depends on how much money people are not putting in the bank, right? Because if I'm keeping a lot of money under my mattress, when I go and put that money in the bank, of course that's going to increase the deposits of the bank, which can then generate more loans as well, right? So two things that depends: macroeconomic conditions, which includes also regulations and the opportunity cost of investing in other things, such as the interest rate on excess reserves, right, which is an alternative for that money, and also on, are people actually holding cash at home, or are they actually depositing that money back with the bank so they can then loan that money out, right? Those are all things that are important moving forward. Okay, so the benefits and dangers of banks, right? Compared to barter, banks are awesome. Money is wonderful, right? It really helps a lot of economic activity to grow. It helps the efficiency of markets, the speed of markets and transactions. So we can say it's a great benefit for our society, right? It facilitates the exchange process. Now we can do online shopping because of this, how the technology has evolved, the banking industry, payment methods, and monetary assets, right? But the problem is, if banks don't work well, man, we have a huge problem, right? There's a credit crunch, right? There's also maybe, depending on the recession and what banks are affected, maybe it will also impact our decisions towards different investment opportunities, right, where we're going to allocate our money. So has severe consequences for an economy when the financial system and the banking industry are not aligned, are not doing well, are not being efficient. Okay, especially for those sectors of the economy that depend a lot on borrowing. Okay, entrepreneurship activities go down because people cannot get those funds to start their companies, right? If people are home construction, because people need those loans to buy mortgages, to buy cars. So all those industries which purchases depend on the ability of individuals to finance those large purchases, they're going to be extremely impacted. Okay, and that's the idea. Now that you know how a little bit about the money and banking chapter, a little bit more the financial system chapter, and you know how the banking industry works, maybe now you can also better understand what industries are going to be more impacted given that banks fail, and so on. Okay, so this ends our chapter of money and banking. And as you can see, I did select a little extra material here. I love doing this part during class. I usually save a whole day just to talk about the Great Recession, and I'm absolutely open to do this during the virtual class. I do love knowing what you guys already know about the Great Recession, so feel free to drop some comments down if you watch the videos that I'm about to talk about and you have any questions, but definitely reach out if you want to know more about it. Okay, we can literally spend a whole semester talking about this, and that's a concept that I really like to talk about, what happened during that Great Recession. Okay, to be able to understand the Great Recession, I won't get into this. I'm just kind of giving a super summary. Feel free to watch this YouTube video that explains the process of securitization and what is securitization for the banking industry. Okay, because that's going to be huge, and it's going to be very necessary for you to understand the next video, which is also, this is all extra material, by the way. I'm not going to be including this on our exams, because I would rather have an in-person discussion about this. Okay, and if you're going to do money in banking, intermediate macro, we're definitely going to talk more about this as well. Okay, but feel free to look at this big video that Margin Evolution did that kind of summarizes the causes of the Great Recession of 2007. And since if you're not familiar with the Great Recession, please take the moment to watch the video. And if you are, please take the moment to watch the video. This is going to be extremely helpful to you, in my view, and it's going to really trigger a lot of good discussions in our virtual class as we had on the class that I held today. Okay, so that's it for Money and Banking chapter. I hope you guys have a better understanding about how the banking industry works and the financial system in the US. The next chapter we're going to talk about is going to be aggregate demand and aggregate supply. Okay, so stay tuned for more videos, and let me know if you guys have any questions as always. See you later.